Yeah, I continue my posture. It hasn't changed much, although I'm starting to see the light at the end of the tunnel. Remember, Scott, what we need here is a capitulation, a shared recognition of our reality. And so the earnings, the downward revision cycle that I've been talking about for months that we needed is well underway. And we see downgrades and estimate cuts day by day. Unfortunate that we didn't get those before 20% of the S&P forewarned that they weren't going to make their estimates, but better late than never. And so when we get on the other side of this revision cycle, when we get on the other side of what is likely again to be a 75 basis point raise and followed by a 50, when we get on the other side of the supply chain healing a bit, then in the fourth quarter, I'll probably start to get more positive. But from here to there, I do expect that there are a lot of headwinds and a lot of negative surprises in store. And as you know, I'm at about 3,400 on the S&P 500.
So you don't think that this bounce off the bottom or that low is sustainable at all? It's just yet another head fake, another bear bounce?
Too many challenges right now, Scott. Like I said, we're going to go through this revision cycle. We're going to have a very chaotic second quarter earnings season with lots of surprises to the downside. We're going to get another 75 bips. And I think all of that will have, at the very least, a psychological effect. And so I don't want to be in front of that.
Jessica, how about you?
Yeah, from a technical perspective, I really agree. We've got a lot ahead of us. Our current support is 36 to 3,700. I'm still watching that 200 weekly moving average, which is at 3,500, and we're looking for the upside and the textbook really bear market that we're in. We're really testing the upwards, really resistance levels as well. And just like everyone is saying, it's earnings season that we're really looking into. There are so many headwinds. We're expecting another rate hike. So coming out of that, sure, there's some positives we can find and look for sector rotation and things of that nature, but it's still ultimately a bear market with bear market rallies with a lot of challenges that we're going into.
Dan, how come no one's looking for surprises to the upside? I mean, there are some people who are actually constructive and positive on the market. Why are they so wrong? What if the Fed doesn't have to be as aggressive as it once was thought to be? What if the economy is strong enough to withstand what they're going to do, as Jay Powell has maintained?
Yeah, listen, earnings season is going to go a long way to telling us something about that. I brought up the Costco report from earlier today. There are a number of other companies that are early reporters that have not suggested the sky is falling. But I think the uncertainty right now, both from a micro and a macro standpoint, is sufficiently large that even though we can dismiss what a lot of corporate CEOs and CFOs have to say, since they are ultimately cheerleaders for their sectors and for their companies, the insight into how they are bearing the level of inflation that they are having to bear is going to be incredibly helpful. Because again, I could paint a story that the S&P belongs at 3,000 just as easily I could paint it that it belongs closer back to 5,000. It's as unusual an environment as I've certainly seen in my career.
I've been, certainly as loud as anybody, Greg, in suggesting that earnings estimates were too high and it was ridiculous that they hadn't come down yet. But what if we're wrong? What if things aren't as bad as people say? And what if earnings, even if they do come down, aren't going to come down nearly as much as some people suggest that they will?
Well, I think this harkens back to something you and Dan were talking about earlier in the segment, which is there is a lag effect to everything that the Fed is doing right now. The tightening, the underwriting standards going up, all of that takes some time to play out. And what I'm more concerned with, Scott, and what I think probably puts some gas on the fire to the opposite of what you're saying here, is that I'm concerned about the consumer. We added we're at 848 billion of credit card debt. We paid down 83 billion during the pandemic, but we opened 229 million accounts in the first quarter, added 50 billion in February, 40 billion. And so I'm worried about the consumer leveraging up just as it's almost becoming historically expensive to do so. And so those things that we thought would support the economy, the strong consumer, great labor market, those things also have counterfactors in that wage inflation isn't keeping pace with normal inflation in the basket of goods that consumers have to buy. And so we can get a recession with a strong labor market, because at the end of the day, the reason that recessions are coincident with a weak labor market is the lost earnings, the lost purchasing power. But we're seeing that anyway because wages aren't keeping pace with inflation, because the market's down, because underwriting standards going up, because it's historically expensive to carry that credit card debt.